So yeah, if you watch the news shows and a lot of these experts, they talk about the stock market being overvalued. Give us, based on what we're looking at here, it doesn't sound like that's the case. So give us some context to that, and how should individual investors be thinking about the stock market?
Yeah. Well, if you just look at traditional metrics of, how expensive is the equity market relative to earnings, things like that, you can certainly make the case that the stock market is overvalued. I mean, we take much more of a flows matter type of an approach where, as long as money is being created and it's going to go somewhere, it can just keep going into equities. And that's regardless of if the price to earnings ratio is 30 times or 40 times or 50 times. The money has to go somewhere. And if it's going to keep flowing into equities, then you would say equities are undervalued because more money is going to come in, and it's just a simple supply and demand type of phenomenon. So, our view is in this environment, no, equities are not overvalued. You would say cash and bonds are probably overvalued, and therefore,
Right.
therefore, relatively speaking, equities are undervalued.
Yeah. Just go back to that personal income chart. This slide's just almost jaw-dropping to look at, and to put it into context, I don't even know how to. So help us put it into context.
Yeah. Well, you look at the scale, and what you're looking at here, the green line is total personal income. And so what you're seeing there is 24,000 billion. So 24 trillion. And when you say 1,000 billion, it really, it shows you how big of a number we're really talking about. We just throw the word trillion around now like it's nothing, but it's a lot of money. And you see that green line there, that's personal income, and it includes all government transfer payments. So expanded unemployment benefits. It also includes stimulus checks. So you see these big humps in the green line. The first hump during the pandemic, during that red shaded area to the right, that's the CARES Act. First time we got monthly stimulus payments, stimulus checks. Then, people spend down their CARES Act stimulus payment throughout the summer. In December, you get the Consolidated Appropriations Act. So another round of stimulus checks. And then this huge spike, that's the American Rescue Plan for March. And, these numbers are just totally off the chart, completely different than what you saw during the prior recession, which was the 2008 global financial crisis, the red shaded area to the left there. And we've been saying this all along, this is really just the cherry on top, if you will, because you strip out all of this government stimulus, all these transfer payments, and what you get is the blue line, which has fully recovered from COVID and is back on an upward trend and is above trend. So I think it's, and we've been talking about this over and over in the outlook, it's very underappreciated by the market, the magnitude of the money creation and the money that has been put into consumers' pockets, and what that can potentially do for economic growth and spending going forward.
Yeah, and we're not over. It's not over, right? I mean, we still have more to come.
Yeah, Congress currently debating roughly $4 trillion in more spending between the American Families Plan as well as the American Jobs Plan. So big numbers.
Yeah, it's yeah, and to your point, it is, and I think in our opinion, underestimated by the market as to how much of this money is going to be flowing into the market.
Right.
We're going to talk about earnings in the next two slides to finish off today's discussion. Just the S&P earnings growth expectations that we went into the year with. So take us through the chart here.
The key thing here is economic growth stronger than expected, not upset by policymakers, creates a TINA environment. There is no alternative to owning equities. And when you think about TINA, how we measure that, the first thing we look at are earnings yields. What do you get in terms of earnings yields versus bond yields? And earnings growth puts upward pressure on earnings yields. So here we're looking at estimates for 2021 S&P 500 earnings growth across sectors. The full S&P is over there on the left. You can see we came into the year expecting about 20% earnings growth was consensus. And through the first 3 months and change of the year, that got revised up to 26%, and it continues to get revised up as companies are coming out and beating even these lofty expectations. And then you look sector by sector, and what you'll see is the more economically sensitive and more value-oriented sectors, you think materials, industrials, very economically sensitive, should benefit from stronger than expected economic growth, really off the charts earnings growth. The energy sector does not compute. So we have a star there because you can't calculate a year-over-year earnings growth if last year you lost money and this year you're expected to make a ton of money. So the energy sector, if you could compute that, would be off the scale.
Oh yeah, off the scale.
A huge rebound in earnings growth, and then financials as well.
Yeah. So let's turn to the last slide and talk about that question of TINA. And given what we're looking at here relative to the expectations, and what happens if we do see 2 or 3x earnings.
Yeah, these different lines are looking at equity risk premiums for different areas of the U.S. equity market. What that equity risk premium basically means is, what do I get in terms of earnings yield minus the 10-year Treasury note yield? So it encapsulates the TINA idea. There is no alternative. And what you've seen is, as equity prices have gone up and interest rates have risen, equity risk premiums have fallen. So equity prices go up, all else equal, puts downward pressure on earnings yields, and then interest rates rise, it eats up that equity risk premium. So that's why you see those lines going down. But you start to factor in this earnings growth we're expecting this year, and that's going to have tremendous upward pressure on earnings yields. It's going to send all of these lines up. And then you think, well, how much higher would the 10-year Treasury note need to go, note yield need to go, in order to eat up these earnings yields? And the answer is, we'd need to see a 3% handle on the 10-year Treasury note for these equity risk premiums to look unattractive. And that seems like a low probability event. Try to think about when that could happen. It would require probably a big policy mistake from the Fed to get 10-year note yields above 3%. So TINA should hold. It should definitely hold. In fact, equity risk premiums should actually look better this year.
Right? Yeah.